I'm here in New York City. I'm Shauna Smith alongside Jared Blickery. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
Happy Friday. U.S. stock futures muted this morning, but we're still poised for some weekly gains after the Federal Reserve stuck with its projection of 3 cuts later this year.
And a big mover this week. It's the second day of trading for Reddit. The stock surged 48% in its public debut after pricing at the top end of the range. You can see in pre-market action just a bit trading to the downside here. But let's get right to it with the 3 things that you need to know, your roadmap for the trading day. Yahoo Finance's Josh Lipton, Akiko Fujita, and Rochelle Akufo have more.
Futures are in the red this morning after major averages saw 2 record-setting days. This was the 4th straight winning session for the 3 indexes as market optimism continues to stem from the FOMC's expectation of 3 rate cuts later this year. Markets are still on course to end the week with strong gains.
Shares of FedEx are surging this morning despite missing the street's revenue expectations. FedEx beat on adjusted EPS in its latest quarter. Bright spots in the shipping company's results also include improving margins in its express business, narrowing its full-year outlook, and looking to extend its multi-year contract agreement with UPS.
And athletic apparel retailers are feeling the pressure this morning. We're looking at shares of Nike and Lululemon sinking on their quarterly results. Nike shares falling about 6% as China sales continue to slow during its busy holiday quarter. Meanwhile, Lululemon sinking after posting weaker guidance and slowing growth in North America.
We do have futures reversing earlier gains, slightly muted this morning, and that's after a Fed-driven rally earlier in the week that pushed all 3 major indices to fresh record highs. And investors are optimistic after the Fed reiterated its 3 rate cut forecast for the entire year. And although Wall Street estimated 6 cuts at the beginning of the year, now it seems like both traders and central bankers are on the same page. And to break down what investors should look for from the Fed going forward, we have Kevin Flanagan, Wisdom Tree Head of Fixed Income Strategy. So thank you for joining us here today. Just briefly, it's been another whirlwind week with the Fed and everything, some macro data points. What's the highlight for you? What can we take forward as we close this week and look ahead to the next?
I think you hit the nail right on the head in the beginning when you mentioned the changing market outlook. We went from 6 rate cuts, which the March meeting was supposed to be the first one. Now the market's happy. We're going to get 3 rate cuts for this year. At least that's what the dot plot is showing. So to me, it's not necessarily when does this process begin. It's what is it going to look like? Are they going to cut rates in consecutive meetings, take some time off? I think that's what we're going to be grappling with as we move closer to mid-year.
And Kevin, with the data now obviously showing inflation remains very sticky and well above the Fed's target, what do you think that rate cut path is going to look like at this point?
A fascinating point that Powell mentioned at what used to be called his Humphrey Hawkins testimony. The Fed may not have to wait for inflation to get down to 2%. So as you mentioned, 2.8. So is 2.5 the new 2%? And if that's the case, you begin to wonder, especially from my vantage point, how would the bond market respond to that if you're seeing CPI readings still coming in at 3.5%. So the Fed's going to need to walk, I think, a kind of a fine line if they go down that road.
Let me posit maybe a worst case scenario for the Fed, which is that it finds itself behind the 8 ball yet again with inflation rising. And we've seen some early indications of this, the 3-month numbers, the 6-month numbers. Even if the year-on-year numbers are still going down or have stalled, we're seeing a little bit of an uptick here. What if the Fed is caught behind the 8 ball? What does that market repricing look like if the Fed has to go even higher or engage in a rate hiking campaign once again?
Well, I think everyone would probably agree there is right now no feeling whatsoever that the Fed would have to reverse course and begin hiking rates once again. So that would be perhaps your worst case scenario going forward, that all of a sudden we go from 2 or 3 rate cuts where the Fed has to contemplate starting up the engines again on their rate hike episode. So I would be leery about that. I think if anything going forward, that what the Fed would do is not necessarily hike rates. They would just keep us right where we're at for a longer period of time.
Kevin, there's so much to know right now. There are so many different scenarios floating around briefly, like we have discussed in terms of what we're going to be seeing here from rates. So what can investors do today or over the next couple of days to take advantage of some of that uncertainty at this time?
Well, I think, from a bond market perspective, it's kind of steady as she goes. We've been talking about slowly, deliberately kind of moving your investments back to a core benchmark in terms of duration. I don't think there's any reason why anyone has to dive headfirst into the pool here. Kind of look at this as a scenario where rates now are in a new regime. Essentially, we've gone back to pre-financial crisis levels, and look at your bond portfolio in that kind of context.
Let me ask you here, what does it look like for investors, given the fact that we have the Federal Reserve? Nobody knows what the central bankers are doing, but we know their trajectories. Federal Reserve on pause right now. Over in Japan, they still have negative rates. ECB a little bit behind the Fed. We have different interest rates around the world. How can investors take advantage of that right now?
Well, I would say right now you primarily want to stay here. If you're a U.S. investor, primarily stay within the U.S. Stay domestic on the fixed income side. We have a treasury suite of offerings that provide for different rate scenarios. That's how I would play it. You can use a laddered approach, which is what we're talking about here with these strategies. You can do a barbell approach as well, where what you're doing is you're really not putting your chip on red where you think rates are definitively going. You're playing this new rate regime. We're in these elevated ranges, and that's where I would focus.
All right, Kevin Flanagan, always great to talk to you. Thanks so much for joining us here this morning. Wisdom Tree, Head of Fixed Income Strategy. Thanks, Kevin.
Thank you.
I have time for today's stock to watch, and that is FedEx. Take a look at this chart because shares are jumping higher in the pre-market trading, up just about 11%. The company beat profit estimates for the third quarter. Their CEO touting improved profitability in a, quote, difficult demand environment. The shipping giant also announcing its board approved a $5 billion share repurchase program, and you can see a slight revenue miss there, but EPS coming in better than expected at $3.86. And Jared, a lot of this, or the beat at least in terms of some of that better than expected of results that we got here last quarter, a lot of that has to do with the cost cutting plan that FedEx laid out several quarters ago and the progress that they have made on that. They're looking to cut nearly $2 billion in costs by the end of this fiscal year and keep those costs off going forward. So that's adding to some of that positive sentiment here in reaction to this report. And also margins improved too, which is also helping the investment scenario.
Yeah, I think that's a larger story there too. And you're absolutely right. It was up to FedEx to deliver here. No pun intended. Sorry about that. It's too early here. But it's really also the old case of its express business versus ground. Express has been a better operating business historically, and that seems to be the consensus on the street as well. I do have a couple analyst notes. Morgan Stanley, they are rating the stock equal weight with a price target that is now $210 up from $195. They're saying while the bulls will like it that the express business was better than feared and the $5 billion buybacks are there, the bears, they're going to point to the continued revenue miss, potential earnings quality issues, and more. And then Jefferies, real quick, says while its express business delivered a standout beat this quarter, volumes were softer than expected at its grounds business. And so I'd just like to go to the Wi-Fi Interactive real quickly and just kind of chart what's been going on this year. We've seen transports at record highs, but I'll tell you what, FedEx is kind of a sideways trading stock. And here's the last 10 years. You can see it's in the upper end of its range, kind of the upper third. But for the most part, that is a very sideways looking chart. So you got to think, gets back up to 280. Is it going to die like it has before?
Well, yeah, I mean, many traders are hoping not, but when it comes to some of the progress, you could be making a bull case in this report, and you could also be making the bear case, right? Just in terms of some of the trends, right? Ground business, volumes were down, margins did improve, but volumes were down on the express side. We did see some strength there, and it is easing some of those execution concerns that we did have going into the quarter. So it's still very much a prove me story when it comes from the investor perspective, I think, but clearly progress is being made on some of those cost-cutting efforts, and we're seeing that reflected in the move to the upside this morning. All right, well, on the flip side, two big retailers sinking on disappointing earnings results here. Lululemon's guidance missing analyst expectations, and also Nike seeing weakness in China, sales slowing in its holiday quarter. You can take a look at Lululemon off just about 13%, Nike off about 6%. Anisha Sherman, Bernstein senior analyst, joining us now on this. And Anisha, you cover both of these stocks. Let's start with Nike. I believe you just reduced your price target there on Nike. When you take a look at this report, weaker margins, sales are expected to decline here in the first half of the fiscal year. What's pressuring those sales in the near term?
Nike is doing something different than what it's done in the last couple of years, which is the good news is it's doing a lot of new innovation. But unfortunately, what that means is older versions of those products, so for example, an older version of a Pegasus or an Air Max that are still in the market, they're cutting those in distribution. And so the innovations are coming in. They're expected to come in over the next year, which is great. But while those are still ramping up, some of the older products are now being cut out of distribution to sort of clean up the market and avoid cannibalizing the new product. And that is what's going to drive some sales declines for a couple of quarters before the new innovation can start to drive sales again.
And Anisha, I mean, this has been a story too, but Nike has been a story about execution. But I'm wondering specifically with respect to China, and just let's focus on that for a second. Nike's in a transition period, so they got a bit of leeway here. If you're the CEO, CFO, just how are you thinking about China right now?
Yeah, it's more macro pressure than Nike issues in China at the moment. I mean, Nike had its fair share of problems back with the Xinjiang cotton boycott in 2021, and then, of course, the lockdowns in 22. But right now, Nike in China, within the sportswear context, is doing very well. It's gaining share. It's doing well with consumers. There are no inventory issues. Retailers like it. Our channel checks are positive. The challenge is just the Chinese consumer doesn't want to buy a lot of discretionary product right now. They're under economic pressure. And so it's not really a Nike issue. It's more a China issue, which, of course, impacts Nike. But I think it's more, I feel more confident about Nike's prospects in China. And when macro improves, so will Nike.
I mean, when we talk about the product transition right now, the focus on the product innovation, also the wholesale reinvestment, what does the timeline look like for that in order to pay out and start seeing some improvement?
So Nike is guiding for another 3 quarters of sort of flat to negative growth while it cuts allocations of existing products and starts to put out these new products. And then starting in calendar 25, so which is Nike's back half fiscal 25, they are expecting to get back into growth. Because by then, these new innovations will have scaled up and will be driving real growth, and they would have cleared out some of the existing products from the long tail of product assortment that they have at retailers and on their own site. So about 3 more quarters, which means we have to wait 3 more quarters to see growth.
I want to shift gears to Lululemon. Got to talk about that as well. Strong results, strong reaction, at least in the stock market, too, about this. But I guess some of the other analysts were warning about the current environments. Fourth quarter is strong, but there are some trends month to date that seem to be troubling some analysts. I'm wondering if you can comment on that.
Yeah, the trends recently. So holiday was very strong in December, and that's what drove the strong Q4 performance. But year to date in January and continuing into February and early March, the trends have been very weak in the U.S. market in particular. And management talked about this on the call yesterday. They said there's some challenging U.S. consumer dynamics. Traffic is slowing. Conversion is slowing. I think it's a combination of macro. I mean, the middle income consumer is getting squeezed right now, and that is the Lulu consumer. But it's also Lulu's getting really big in the U.S. It is the #1 market shareholder in women's apparel. And you can't keep outgrowing the market once you're the market leader. And so a little bit of that slowdown that was overdue is finally caught up to the stock.
Anisha, is some of that slowdown a bit surprising to you, given the fact that high-end consumer has held up so strong up until this point, and Lulu hasn't really seen much of that pressure before?
But I think the key in what you're saying is up until this point. Yeah. We are seeing weakness in the high-end consumer now, where other premium brands, if you talk about Nordstrom, you talk about Coach, you talk about Kering, they are seeing weakness in that consumer, which is the Lulu consumer. So it is not just low-income pressure anymore. It is really creeping up the income spectrum and is hurting that Lulu consumer in a way that it wasn't a year ago.
Anisha, since we're kind of in between earning periods right now, any thoughts on trends that you've seen develop over the last quarter, heading into the next one? What are the kinds of things that are on your radar right now?
We're seeing continued softness in the U.S. market and consumer. Once we get to the summer, I think we will start to anniversary some of last year's softness, so we should see some incremental growth, and particularly for the sportswear brands who are seeing some big sporting events coming up, the Paris Olympics, the Euro Cup and soccer. That should drive some traction as well. So H2 is looking more optimistic than H1. H2 order books are stronger than H1, and H2 inventory levels will be cleaner than H1. So it does feel like it's a bit of a year of two halves where we're still in the thick of the H1 weakness, but things will start looking better as we get into mid-year.
Anisha, what do we need to see from Lululemon to spark some of that reacceleration of growth?
I think we need to see some growth in the men's business. So this has been a big growth area for them, which was meant to be, helping to offset some of the slowdown in the core women's business. But men's has actually underperformed women's this year. And, Lulu's CEO on the call yesterday talked about how men are a little bit more conservative with buying as well. But he also talked about new innovation that they have out. They have new men's pants, new men's shoes. So if we see that starting to work and the men's business starts picking up, that may offset some of the weakness in the women's business as it starts to mature and slow, which will be a positive catalyst.
Now, our colleague Brad Smith, very excited about the new lineup of men's shoes over at Lululemon. All right, Anisha Sherman, always great to talk to you. Thanks so much for joining us here. Bernstein, a senior analyst. Thanks, Anisha. Well, coming up, Tesla is sinking after reportedly cutting back on its production in China. We are going to break down some of the top trending tickers. You got Tesla shares off just about 3.5% in pre-market trading. We'll be right back.
Time now for some trending tickers. Investors unplugging from Tesla this morning after reportedly reducing production at its China plant. That's according to Bloomberg. The report claims that the EV maker told Shanghai employees to cut back on production of its Model 3 and Model Y vehicles by working 5 days a week instead of the typical 6.5. And Shauna, first, hats off to those people working 6.5 days per week over there. I don't know the exact. I'm not trying to make light of this, but I think it's interesting because I was reading some broader stats out about the car situation in China for overall passenger vehicle sales. That includes the ICE, that includes EV. Those increased 17% in the first 2 months of the year. But Tesla is recording a decline in shipments from the same period a year ago. And I just think this speaks to the broader, very competitive environment in which Tesla finds itself. It's been a leader in terms of price cuts sometimes, but it's a two-way street. And it's just showing how difficult this very difficult market is, that being China.
Yeah, exactly. And take a look at this data here that we've got now from China's Passenger Car Association of the first 2 months of the year. Like you were talking about, sales actually declined for Tesla. They were down 6% compared to what we saw a year ago. And I bring this up because only 53% of the shipments went to the local market there in China. And this comes despite the price cuts that you were just talking about there, Jared, that Tesla has been carrying out really since the start of this year. And we started to see it play out at the end of last year. The increase in competition, the lower priced local players there has certainly made it tougher for Tesla to continue to make inroads into China. That paired with sluggish growth and also a struggling economy in China has certainly been a headwind for Tesla and many of its competitors within that market. And then coupling that up with what we're even seeing play out here in the U.S., you have many consumers who are staying on the sidelines. They're not buying EVs at the rate that they were expected to up until this point. And that's certainly been a huge reason why Tesla has been one of the worst performers within the S&P since the start of the year.
Yeah, since you mentioned performance, let's go to the Wi-Fi Interactive real quickly and just chart the year-to-date performance. And you can see going the wrong direction, upper left to the lower right, but we are in the midst of some larger trends here. And Tesla, for its part, has been going sideways since, since late 2022. That's a 3-year chart. If we put a 5-year chart on, you can just see this is a lot of trendless action here that gets investors excited to the upside and to the downside when we get to some big levels. But we're closer to support than we are to resistance. So I got to think investors might want to think about at least trimming their exposure to the downside here, maybe thinking about some longs, but maybe a discussion for another day.
All right, well, again, Tesla shares trading to the downside here in the pre-market. Well, let's take a look at another trending ticker that we're watching, and that's Digital World Acquisition Corp. Now, shares are moving higher in the pre-market, up just about 3%. Shareholders getting set to vote on whether or not to merge with Trump Media and the technology group, the company behind Truth Social. Now, if accepted, former President Trump would have a 58% stake in the merged company. Now, this has been a long time coming, the reverse merger agreement. We feel like we have been talking about this forever. It was first announced back in October of 2021. So we've been talking about this for just about 2.5 years. The significance, though, of this, obviously, it could potentially be a big payday for Trump. We mentioned that 58% stake that he would have in the merged company. It would be worth more than $3 billion. So it could help him maybe resolve some of his financial issues. But again, DWAC, a trender to watch today. And there's certainly, look at that pop there since January, moving to the upside in the last couple of months.
Yeah, I'm seeing that Trump is set for a payout of $3.4 billion. There's got to be other incentives in there, too. But just shows you how much is on the line here. And real quick at the Wi-Fi Interactive, if we can go to that chart real quickly. This is since inception, and this is a SPAC. So it came to market at $10 a share. Got a lot of interest way back in 2021 initially. Had a second top here, and this stock looks like a biotech. And sometimes it happens with SPACs because you're waiting on decisions and votes to be made, but just a very volatile trading instrument here.
Yep, so this is up for a vote today. We are going to be continuing to track that. Again, shares of DWAC, Digital World Acquisition Corp, trending on Yahoo Finance today.
And real estate firm Compass is the first big brokerage to reach a settlement over allegations it was part of a conspiracy to keep real estate commissions high. Compass has agreed to a settlement of over $57 million. This comes just after 1 week after the National Association of Realtors landmark settlement. And now we have shares of Compass. They are edging higher this morning. And just a quick look at the Wi-Fi Interactive for some charting here. This has been a slow and steady decline over the last 5 2025. This goes back to 2021 coming to market. You could see 82%, down 82% over that time. Here's the 1 year, it's sideways. So this is another kind of trendless chart we're looking at here. To the upside might be interesting if we got to $4 and might get there on the open. We'll have to see.
Yeah, certainly. There's been a lot of coverage on this ever since the NAR settlement was agreed a week ago today, and exactly what this is going to do for many of the platforms like Compass. And I was taking a look at a couple of analyst notes out this morning, and many of them are in agreement that Compass is actually amongst the worst positioned to be hit the hardest because of this, just given the heavy reliance that their business does have on some of those commission fees that are generated through the buying and selling process. So again, we are expected to see more agreements like this. The announcement that we're getting here from Compass today, $57.5 million to settle some of those antitrust claims. Now, exactly how this is going to overall, taking a step back and talking about the NAR's settlement here, how that is going to impact the housing market. There is some debate just in terms of whether or not it's going to be good for consumers or buyers potentially in the end, if it's going to help the pricing of homes come down just a bit. But we certainly have seen this story trending on Yahoo Finance because so many people are trying to figure out what exactly it's going to mean for them personally if they're thinking about selling their home or if they're out there thinking about buying a home. And
that's why we're here with the real estate experts that we bring to you on a daily basis.
All right, we'll keep right here on Yahoo Finance. We're just minutes away from the opening bell on Wall Street, just about 4 minutes away. We will be taking a look at some of the biggest movers in today's trading action. Again, it looks like all three major averages set to open the day in the red. We'll be right back. We're about 20 seconds here from the opening bell. Lots of focus is going to be on those three major averages right at the open. We're coming off another day of record highs. You can see the S&P where it closed yesterday was actually its 20th record close of the year, well above that 5,200 level that we know has been so critical for so many investors out there. There has been this march towards 5,300. And then when you take a look at the Nasdaq, another record high for that composite yesterday. Now we saw this move to the upside up just about 0.2%. So stocks taking a bit of a breather here right at the open as we get some excitement from the floor of the New York Stock Exchange and from the Nasdaq here as the market looks to wrap up what has been another record-setting week, and much of these gains coming despite many of those larger cap tech names that have remained under pressure. When you take a look at some of those individual movers here at the open, let's look no further than some of the tech giants and what we are seeing. Apple was a big story yesterday, that DOJ suit, obviously putting pressure on Apple's market cap yesterday. Actually lost over $100 billion in market cap just yesterday. So we're seeing a bit of a rebound here today at the open. On the flip side, though, you're taking a look at Tesla once again in the red on an intraday basis and taking a look at that 5-day chart. This move here to the downside that started yesterday, continuing today off just about 3%. And we've taken into account the underperformance of Tesla really since the start of the year, one of the worst performers within the S&P. You're looking at a year-to-date loss right now of just about 32%. Now, beyond tech, let's take a look at some of those down movers here, because again, a better look at what exactly is going on here. And we got another read on the barometer here on the health of the economy from FedEx and those strong results helping some of that sentiment out there today. JP Morgan also in the green today, followed by Disney and United Health also moving to the upside, able to offset some of the losses that we're seeing from some of those larger tech names. Amazon off just about 0.5% here at the open. Well, stocks taking a breather in early trading, but it has been a record-setting week here for the market. The S&P notching its 20th record close of the year on impressive breadth. Now, every sector is higher for the week, and it's not just tech that's leading the charge. You've got financials and industrials are both up more than 3% on the week. Here with more, we want to bring in Keith Buchanan. He's Global Investments Senior Portfolio Manager. Keith, it's great to see you here. So I think a lot of investors are wondering whether or not this movement to the upside, this record-setting gains that we have seen, whether or not that trend can continue. Do you think there's enough to keep that momentum intact?
Well, thank you so much for having me this morning. Our view is we've seen a lot more from other sectors outside of technology, communication services that perhaps indicate that this real economic growth that the market and our economy is really building is spreading beyond the AI generation and the names that have benefited from that push into this new phase of technology. Those stocks have exploded, and it's not necessarily unwarranted because the margins and the earnings have started to justify it. But we're seeing other names outside, like Waste Management, Walmart, some of the banks that are showing a lot of positivity in this marketplace. And we would want to be more diversified away from those larger names as they're starting to kind of show some weakness that we're not all that enthused about.
Yeah, I'm glad we're talking about this and the broadening of the rally because we're looking for new opportunities. You mentioned some of the financial stocks. XLF, the large cap financial ETF, just notched a record high this morning, and it only recently started hitting record highs again. It's a lot of sectors are finally catching up to the tech sector. We've seen industrials actually arguably stronger than tech this year. I'm just wondering, besides what we've talked about here, and you can talk about some of the industrials or individual names, but where are you looking?
And we're looking outside of I guess now it's not the Magnificent Seven, maybe it's the Dynamic Duo or whatever moniker we have. But those names have started to show some weakness. And we've been involved in JP Morgan for some time now. It's one of our favorite names in the financial space. Just best of breed. The financials have shown really an appetite for this potential steepening of the yield curve as the short end moves lower as we go into perhaps a cutting cycle at some point this year. And the long end stays higher as inflation seems stickier, real growth seems to be a little more widespread. The banks stand to benefit from that as well. And the valuations are depressed from a historical standpoint. Industrials, like as you mentioned, Waste Management is a name we've owned for a while as well. And we're looking at all those names that have margin expansion opportunities as the disinflation hits their input costs earlier than they hit their pricing. I think that's what we saw yesterday with Nike. FedEx also had some similar comments in their margin commentaries. So we're really excited about those names that are more traditional, not necessarily as sexy as some of the AI names, but names that have historically gotten a bid in this type of market environment.
Keith, will those names, do you see those names holding up if in fact the Fed does end up only cutting 2 times this year?
Indeed, we think that the with real growth kind of hanging in there at 3%, 2%, that environment, as long as disinflation doesn't move us beyond the 2% target, we feel like that's an opportunity in an economy. There are a lot of real kind of boots on the ground, Main Street businesses can really thrive in. And they're just not, they've been forgotten for some time because of, there are a lot of factors that play into it. We feel like one is just the index move that we've seen of passive investing over the last decade or so that's only accelerated, has just pushed a lot of resources away from those names. And we feel like they offer valuations at this point that are really attractive given the prospects they have in the economy.
We've been talking about a number of retail earnings out this morning that you just touched on, Nike, FedEx, wondering, and Lululemon, I should add too, and especially just focusing on the latter, there were some trends that some of the analysts noted very recently. So this would be for the current reporting quarter that suggests maybe things are slowing down a bit. Just wondering, in these earnings or anything else that you're reading, are you seeing a slowdown in the consumer?
We're seeing the consumer become a little more selective. Walmart mentioned in their last quarter that they've seen the basket size improve and moved away some from being as exclusively groceries as we saw kind of in the part of the pandemic. They're showing some changes, but not necessarily a drawback. I would look at Lulu in a very specific kind of niche market. I wouldn't really extrapolate the Lululemon customer across our broader economy. We're taking our takeaways from those larger FedEx, how many boxes are they moving? Walmart, how many customers are coming in the door? How much are they spending on each ticket? And that's given us a better sense of the more moderate U.S. consumer and how they're behaving in this moment. And they're getting wage gains that are beyond inflation at this point. So real wage gains that are filtering back in our economy in ways that we feel like are optimistic for the rest of this year.
All right, we're going to have to leave it there. Really appreciate you stopping by. Keith Buchanan, Global Investment Senior Portfolio Manager. And turning now to the top trending ticker on Yahoo Finance, we are watching shares of Reddit. It is trading slightly down this morning, and that's the company's second day of trading. Move comes after the stock popped 48% on its debut. And Shauna, that pop we got was after 1 p.m. yesterday. So these IPOs coming out a little bit late in the day, but we haven't had that many to focus on. And so a lot of people looking on this with eyes towards, well, can we extrapolate what this means for the broader M&A market, the broader capital markets coming to market, trying to sell your shares? I don't know what kind of case this makes, but there were concerns that because they were selling directly to people who didn't have a lockup, that there might be some volatility. But it looks like the volatility has been to the upside, which generally investors tend to like.
Yeah, certainly popping 48% the first day of their public debut here, the first day of trading on the public markets. And that also follows some of that excitement that we saw earlier this week with Astera Labs, when that stock jumped just about 72%. And I bring that up because Reddit has really been trying to sell itself or position itself, at least in the minds of investors, as an AI play, and the ability really to capitalize on that AI strength and growth here over the coming quarters and really get eventually its business to profitability. We saw some of that excitement yesterday when you take a look at the shares popping. Also from Astera Labs, that stock up just about 72, or was up 72% in its first day of trading. Whether or not, though, we can really say that those two names make a trend, it's too early to tell, but it shows the excitement.
It shows the excitement. I think that's a broad takeaway because Reddit was able to make one sale to Google for what, $60 million, and now everybody sees trillions of dollars in dollar cents. I would too if I just sold Google. I don't know how much the data is worth. I don't know if anybody else does either, but I mean, that's what we're going to try and figure out. I just think this is an old school media play. They haven't tried to make money or really tried to gear up towards monetization in 20 years. They're finally coming to market now, but is there a plan? And I just don't know if that's been articulated yet.
Yeah, exactly. And I think that's a lot of people who have been skeptical of this public debut, skeptical of Reddit being able to prove it is on a sustainable path here to profitability. I think that has a lot of people, or has kept some of those skeptics on the sidelines, at least for now. But again, Reddit shares opening the day just a bit lower. But again, after shares soared almost 50% in the first day of trading. Keep right here, though, on Yahoo Finance. We've got much more of your market action ahead. We'll be right back. Bitcoin prices sliding this week, now hovering just below $64,000. Our very own Brad Smith is live from DeFi Technologies' inaugural Bitcoin Investor Day, taking place in the center. He's in the center of the action in Midtown Manhattan. Brad, what are you hearing?
Hey, Shauna. Yes, here at the first inaugural, and I guess inaugural would be the first anyway, but the inaugural Bitcoin Investor Day in Manhattan, and it certainly is a vibe. It's exciting, a lot of Bitcoin energy, and I don't think I've ever seen a megapod quite like this. Why do I say megapod? Well, in marine biology, they have what's known as a megapod when you have a great deal of whales in one setting. And that's what we have here today. We've got a great deal of Bitcoin whales, those who hold a serious amount of crypto in either cold storage, hot storage, or are trading them liquidly. Now, here's what's interesting. Of course, the setup coming into this first inaugural Bitcoin Investor Day. Number one, you've got new record highs that we've seen already this year. We pulled off of some of those levels recently, but I had the chance to speak with Anthony Pompliano of Pomp Investments, the founder and the organizer of this event. about what that next inflection point might look like and what this meeting of the minds or of the whales sets forth in terms of the conversation and then the initiation in potential trades from this point forward. Here's what he had to say about that next inflection point.
I think that one of the beauty of Bitcoin is that the narrative is so simple, right? For the average person, it's I can just save in an asset that isn't debased. And that tends to protect or increase my purchasing power. Very simple for them to understand. They don't have to be up to date every single day on what is the price or what is happening. The same thing now is kind of that simplicity coming to Wall Street as well. And so Wall Street is saying to themselves, wait a second, we can just buy an asset that protects this quote unquote purchasing power. But when you have individuals and institutions both doing that, that demand outstrips supply. And so from an investor seat, you're like, wait a second, if there's more demand than supply, the price is going to keep going up.
And Pompliano was just one of the voices that we're going to be hearing from today, and that is going to grace the stage behind us here. You've also got Anthony Scaramucci, who we're going to be speaking with later on today of Skybridge Capital. You've got Mike Novogratz. You've got Robert Mitchnick of BlackRock. Bitwise is represented here. So a ton of both ETF issuers as well as long-term holders or hodlers of Bitcoin as well, where we're going to hear a lot of those voices really taking place in conversation and hearing what's next for the future here from their anticipation. Of course, I've also been tracking the crypto market cap, the global crypto market cap over the course of this morning, and we're down right now about over the past, about 4% over the last day here. So there's going to be a lot of focus on the halving coming forward in April. There's going to be a lot of focus on the atypical nature that we're seeing of new all-time highs ahead of a halving and what that sets up for some of the price targets that we've heard for the rest of this year as well. So I'll toss things back over to you, but we've got some great conversations coming your way right here from in Manhattan, just a little bit north of you guys in the studio. Shauna,
All right, Brad, you certainly have a packed day. We look forward to listening to all those conversations that you will be bringing us throughout the day. Thanks so much, Brad. Well, the Justice Department and 16 attorneys general suing Apple, claiming that the tech giant violated antitrust laws by blocking its rivals from accessing both hardware and software features on its iPhone devices.
We allege that Apple has consolidated its monopoly power, not by making its own products better, but by making other products worse.
And that was enough to send Apple shares into the red yesterday. It sold off on the news, wiped over $100 billion off from its market cap in just one day. And you can see it also lower once again today. We want to bring in Gil Loria. He's D.A. Davidson's managing director. Gil, certainly we saw a lot of jitters play out in the market yesterday on the reaction to that news. How are you looking at it? How big of a deal this could potentially be for Apple's business?
It is a big deal. So the difference between the regulatory scrutiny of Apple so far is that the scrutiny from the EU was about the App Store and access to the App Store. And mind you, that's an important part of Apple's business. It's the fastest growing business, the services business. But this goes to the heart of Apple, to the iPhone. The Department of Justice is coming after iPhone. They're pointing out a series of practices that Apple has engaged in order to make sure that people continue to buy iPhone and not buy Android phones. And if Apple has to remedy all those measures, even if they're successful in mitigating some of these impacts, it will by definition weaken Apple's hold, especially in the US iPhone market, handset market for iPhones.
And how should investors be thinking about this, especially when it comes to the timeline? Because we think back to historical precedents like Microsoft that took over a decade to play out, arguably 2 decades. I think it started in 1990. So we're talking about some very potentially long-term playouts here, but not necessarily payouts. How should investors be thinking about the short term, the medium term, and the long term?
I think that's right. And I think that's a good analogy. And if you think about what happened to Microsoft, it's not that the Office Windows monopoly was broken. It still hasn't been, even 25 years later. It's that Microsoft was limited in its ability to move into the next waves. Let's not forget Microsoft missed the move to mobile entirely and then was late to cloud. And that was a much longer term impact. For Apple, also, in the short term, there's little reason to think that it's going to impact iPhone sales this year. But if they do have to come back from and withdraw from some of those practices, it will, over time, in the medium to long term, loosen their hold on the handset market, especially in the US. So iPhone prices may not be able to go up as much. It may make it more conducive for consumers to buy Androids, let's say for their kids. And if that happens over time, that is a pretty big headwind to that key iPhone market.
Yeah, but Gil, how strong is this suit? Because I was going through a number of your colleagues out there, the reaction to the suit yesterday, and several of them in their notes this morning bringing up the fact that this is actually going to require the U.S. to write new legislation here from Congress because existing laws make it very difficult to prove here that Apple operates a monopoly. Do you agree with that, or do you think actually that this suit is very strong and it could prove given the existing laws now?
I think the focus is less on whether Apple is a monopoly or not. It's more about those business practices around possibly even degrading consumer experiences in order to keep them in the iPhone ecosystem. Famously, the Android to iPhone SMSs, but also things like cloud gaming, access to wallet. These are things that the DOJ can and may be able to compel Apple into changing those practices, allowing cloud gaming, allowing other watches to connect to the iPhone, allowing other wallets to be on the iPhone. All these things, if you make iPhone more interoperable with Android devices, you make it less likely that a consumer trying to buy a low-end phone is going to buy an iPhone, more likely that they'll buy an Android. So the case is compelling not because of iPhone, of how much of a monopoly they have. The case is compelling because they've found some smoking guns about Apple saying that it's degrading consumer experience in order to keep them in the iPhone ecosystem. That's really the crux of the issue here, not how big Apple is and iPhone is in the United States.
So Gil, what's the likely outcome and what does it mean for investors?
So I would say that since this is a long-term headwind to Apple, I would be more focused on the benefit to everybody else. So this is good for Android, that's Google. It's good for application providers, that's Google, that's Meta, that's Microsoft. Other application providers will able to do more in the ecosystem because iPhone will have to open up more. It's good for practically everybody else that serves consumer applications, by the way, including banks that may get more unfettered access to consumers using their own wallet if iPhone it goes beyond just giving you the Apple Pay to allowing Bank of America Pay, Wells Fargo Pay, Chase Pay, then that could open up opportunities for all those companies. So Apple has this tremendous base of profits. Some of that is going to now leak and be captured by other application providers in this ecosystem.
All right, Gil Loria, thanks so much for taking the time to join us here. D.A. Davidson's Managing Director. Keep right here on Yahoo Finance. We've got much more of your market action ahead. We'll be right back.
Foot Locker shares rising this morning following an upgrade from Citi. The firm lifting its rating to neutral from sell, citing that the retailer could see benefit in pivoting its focus back to its wholesale channels after growing too focused on its digital business. And Shauna, I think the picture is worth 1,000 words. Let's go to the Wi-Fi Interactive where I have our apparel heat map up and a lot of dark red. Look at that. Lulu down 17%, Nike down 8%. Foot Locker, though, up 5%. So kind of bucking the norm here, or bucking the existing trends that we're seeing today. And I think the key line there is that, Nike went a little bit too far emphasizing digital over wholesale, and now they got to dial it back up. And I get it, Foot Locker is the beneficiary, but this is a stock that has really just traded sideways over the last year, over the last 2 years, basically.
Yeah, certainly. I mean, there's only almost one way to go for Foot Locker at this one, given the amount of pressure that it has been under. So Citi at least saying that right now valuations look a bit more compelling than they did following this massive slide that we have seen in the stock. And even take a look at that year-to-date chart with shares off just about 20%, 3 months off about 19%. And so, which I guess 3 months is essentially since the start of the year at this point. But when it comes to what is it going to take to turn Foot Locker's business around, Citi making the argument that the shift here from Nike is going to help just a bit. But I think what that long-term goal is going to be and exactly how Foot Locker remains competitive within a landscape that has become increasingly competitive with its rivals. They have struggled really to carve out their niche, to execute on those turnaround plans. So I think many investors still, though, remain skeptical about what exactly that road ahead looks like from here.
Nevertheless, raising the price target, this is Citi to $24 from $19.
All right, we'll keep right here on Yahoo Finance. We've got much more of your market action ahead. We'll be right back. Welcome back to Yahoo Finance. I'm Shauna Smith. It is Friday morning, just about 30 minutes into the trading day. Let's take a look at how things are shaping up. We're seeing some pressure here across the board. You've got the S&P off just below the flat line. Investors digesting what we heard from the Fed earlier this week. Jay Powell reiterating the fact that the central bank does see 3 cuts before the end of the year. That was enough to lift stocks to record highs yesterday. So again, giving back some of those gains today. Let's get to some of those individual movers, some of the stocks that we are watching. That first one, let's take a look at Dutch Bros. Dutch Bros under a bit of pressure here this morning. The stock off just about 5%. The coffee chain announcing an underwritten public offering of its Class A common stock. Just Bros is looking to sell stockholders associated with TSG Consumer Partners 8 million shares at the offering price of $34 a share. Now, the public offering is expected to close sometimes next week, and you are seeing Just Bros trade just above $33 a share. We're also watching shares of Best Buy. JP Morgan upgrading the stock on the electronics retailer from neutral to overweight. The analysts there saying that they see more demand for their products and believe that deflationary headwinds are going to moderate soon, which should help the company improve its growth going forward. Again, the stock up just about 2%. And Humana shares ticking higher after Raymond James initiated coverage on the stock. They gave Humana a market perform rating and also set a price target of $20 a share. Raymond James seeing limited near-term upside for the health insurer despite facing elevated Medicare cost trends and competitive dynamics over the last year. The stock, though, up nearly 1% today. Well, tech stocks, they're always in focus. Apple shedding billions in value after the DOJ filed an antitrust lawsuit yesterday, citing that the company's alleged monopoly in the iPhone market. Apple is a big underperformer so far this year. It's one of just 3 Mag 7 stocks that are underperforming the S&P 500, the others being Tesla and Alphabet. Our next guest, though, is saying that there's one Mag 7 name that is still a buy. And he's taking a look at shares of Microsoft. They're up about 14% this year, outpacing the S&P 500 today. They're off just about 0.2%. But KeyBank initiating coverage on Microsoft as overweight, the price target of $490 a share. Joining us is the analyst behind that call. We have Jackson Ader. He is KeyBank's managing director of software equity research. Jackson, it's great to have you here. So talk to me just about the bull case that you see from Microsoft at this point and why they are among the best positioned within the AI space.
Sure. Yeah. Thanks for having me, Shauna. So there are really a couple of things that we like about Microsoft. The first is in AI, there are really 3 ways that we see you can monetize AI, and they are a leader in the 2 ways that we actually like. So between Azure actually metering some of the move to the cloud, more workloads going to the cloud from AI, and from just direct monetization from Copilot. $30 per user per month is a pretty straightforward way to actually get a return on all those investments. Those are really in AI. They're leaders. They are actually putting revenue on the board right now, whereas a lot of other software companies, it's speculation and it's the future. So as far as AI is concerned, those are the 2 bull cases.
And Jackson, there has been some debate around Azure's growth right now, it being a mix between AI and non-AI, and some have taken issue with that mix. The fact that AI is playing a bigger role within that, should that be viewed as actually a good thing, a bullish view here at this point for the stock?
Yeah, I'm not terribly bothered by it. I'm not sure why I'm supposed to view I call it the first generation, right? The move from on-premise to public cloud as positive and the AI workloads as any different. Now, I do understand the pushback that because of maybe the partnership with OpenAI and, it's a quasi credits acquisition type of relationship where maybe the revenue isn't as high quality specifically as it's related to OpenAI. But I think that when the company talks about more of the AI workloads on Azure coming from inferencing, I'm encouraged by that. That, in my opinion, should be stickier than the training of the models where you have this big spike maybe in the initial training, but you have more sustainable workloads coming from inferencing. So I'm not particularly bothered by the split between AI and call it traditional public cloud. And we're seeing from other public cloud vendors that the first generation, just the plain vanilla, call it public cloud, is actually starting to reaccelerate. We're getting past the optimization cycle. So I see them both as tailwinds.
I mean, take a look across just the software space here and the catalyst that you just laid out here from Microsoft stock. How does that stack up against some of those rivals, and why do they have, or what's really giving them that edge, or how big of an edge is it in the long run?
Well, based on our survey work, when you ask CIOs about whether it's the strategic vendors or just the public cloud vendors and the capabilities in AI, Microsoft dominates. More CIOs responded with Microsoft having artificial intelligence capabilities that are superior to others than any other vendor and actually doubled the next rival in terms of AI. It's hard to disaggregate how much of that actually is tangled up in the relationship with OpenAI, but customers are saying, this is where we want to go for artificial intelligence. This is where we want to go for the vendors. As far as some of the other competitors, I actually think that when we saw what we saw from Oracle results a couple of weeks ago, where Oracle Cloud Infrastructure put up good numbers and good growth, and the backlog related to that OCI number was massive, was a hugely above street expectations. That's a validation point, I think, in artificial intelligence driving more workloads to public clouds. And so we're looking around at competitors and saying we're getting some validation, and customers and CIOs are saying that Microsoft stands alone as a strategic vendor here, and that should be good in the long run.
Jackson, when you take a look at some of your other coverage within the software and enterprise space here, you also like ServiceNow, you like SAP, like Oracle, like you were just talking about. What's that common thread? Is it just all about AI, the plans there, and what that's going to do to these companies' bottom lines? Because it is a little bit different when it comes to each of those bull cases that you've laid out for these top names.
Right. So it's not all about AI. And we can run through some of the specifics on those, but if you think about Oracle, sure, a lot of their growth, and they are entering that kind of single metric mode where, the quarters are going to be defined by, did OCI grow by, this percent, or did it grow by this percent, plus or minus a couple. And so I understand that as far as Oracle is concerned, we're maybe moving into the AI drivers, but SAP, ServiceNow, and Oracle, they also have just large cloud platform plays, and specifically around the ERP players, so SAP and Oracle. As their cloud applications start to mature and you start to see the benefits, not only from the efficiencies of moving applications to the cloud, but also the product enhancements that should come with faster innovation, quicker time to market, they should be able to close the competitive gap against the pure play cloud competitors in the ERP and in the HCM space. And so that should help gross retention. It should help net retention. And I think that there are cloud application reasons why you should own Oracle and SAP. ServiceNow, ServiceNow, it's the ultimate platform. And we said in our initiation, ServiceNow gets to see where the puck is going and skate there, because they can spin up seemingly any workflow automation tool for any use case. They are the ultimate platform in a sector where everybody says they want to buy a platform.
Yeah, certainly. We have seen a strong move here from ServiceNow. I'm looking at the year-to-date chart, up just about 13%, but the 1 year, though, up nearly 80%. Jackson Nader, great to have you. We'll look forward to having you back here on Yahoo Finance soon.
Thanks, Sean.
The Department of Justice, alongside 16 attorneys general, filing a lawsuit yesterday accusing Apple of violating antitrust laws. The DOJ saying that the tech giant is blocking its rivals from accessing both hardware and software features on its iPhone devices. This is a culmination of a 5-year probe into one of the world's most valuable technology companies. For more on Apple's legal trouble and the next steps in this landmark lawsuit, we want to bring in Randy Picker, University of Chicago's law professor. Professor, it's great to have you here. Just talk to me about the nuts and bolts of this suit. How strong do you think this suit is here from the DOJ against Apple?
Look, they're going to face two critical issues. So in any antitrust case, we worry about market definition. What's the market? And this is an attempt to say that Apple has a monopoly in the smartphone market. They've got a couple of versions of that. We've seen litigation like that before. So Epic, maker of Fortnite, ran a lawsuit like that. That was in a different court. They concluded there that Apple wasn't a monopolist. So that's one issue. Second issue then is, assuming you find monopoly, then you only get in trouble. You're allowed in the United States to compete and win, and Apple has certainly done that. The question is, what have you done with your monopoly that's problematic? What's illegal? And what we're going to want to focus on here is the critical issue here, and you talked about it a little bit, is this question of how does Apple play with others, and what sharing obligations does Apple have with regard to the inside workings of the iPhone and devices like the Apple Watch?
Will we need to see new legislation pass in order to prove or in order to enact any meaningful change when it comes to Apple's App Store, when it comes to that third-party App Store policies, just given what you just laid out and what we have seen play out in the past?
Yeah, so a couple thoughts on that. So Europe is running this experiment right now. So Europe passed a law called the Digital Markets Act. They've just turned that on. When you turn on an iPhone, you see choice screens for the browser, for the assistant, for search. And that's all driven by recent new legislation that they're going to fight about. We considered legislation in this country. My law school classmate, Amy Klobuchar, Senator Klobuchar, tried to get bills through. Those did not succeed. That would clearly be a different path, and in some ways, other than the politics, and I'm not a politics expert, a cleaner path than what's going to be a long, hard slog, I think, in the court system.
And this wasn't exactly a surprise. Like I mentioned there in the intro, there have been talks about this. They've been looking into this, going back to the Trump administration for the last 5 years. Talk to me just, though, about the timeline process of this and how long a suit like this typically takes to work its way through the courts.
So I've been listening to your coverage. So the Microsoft case, there was an initial case against Microsoft in 1994. That one settled. Settling a case moves things so much faster. So we shouldn't be afraid of settlements. There have been some famous settlements with other tech firms in the past, AT&T. If we're going to litigate and litigate to the hilt, that's going to be 3 to 5 years probably.
So 3 to 5 years. Well, I know it's very early and we just got this suit yesterday, but from what we know now, how do you see this ending? Do you see Apple prevailing in the end?
I want to take it in steps. Yeah. What happens at the district court? Don't know. Don't know the district court judge. So then the question is what happens on appeal and then ultimately possibly to the Supreme Court. To answer your question, yes, I think Apple will prevail in the end. They may not prevail in the first instance. It may have to go up a level, maybe up 2 levels. But yes, if you're asking me for a guess, my guess is they will win.
All right, Randy Picker, great to have you. I have a feeling we will be talking to you a couple times here over the coming months, given the activity that we've seen. Randy Picker, University of Chicago's law professor. Thanks so much.
Thank you.
Well, coming up, a milestone moment for Intel, the U.S. government awarding the semiconductor giant up to $8.5 billion in funding through the CHIPS Act. We will hear from Intel CEO Pat Gelsinger on the other side of the break.
Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th.
big moment in history for Intel, receiving $8.5 billion in fresh funding from the government. Let's get right to Intel CEO Pat Gelsinger. Pat, good to see you. I understand this is a very big moment for your company and for you as a leader. This funding, what will it allow you to do?
Well, overall, as you think about this, we've been working on this rebuilding of the American supply chains and semiconductor. The challenge has been that we just weren't economic to build manufacturing in the U.S. There's been 30 years of industrial policy in Asia, and we've seen the entire industry drift to Asia as a result. So our supply chains became precarious, and we saw that through COVID in a very acute way for the entire industry and economy. And what this funding is about is rebalancing so that we can be competitive with our manufacturing investments in the U.S. And that's what the CHIPS Act was all about, right? And yesterday was the day where it all came together. So it was so exciting to be in Arizona with the president, with Secretary Raimondo, these big grants coming forward, and $8.5 billion of immediate grants, $11 billion of loan capacity, and about 25% of $100 billion investments, so 25 plus billion of investment tax credit as well. And putting that all together, that's $45 billion committed to the industrial policy of rebuilding the supply chains of the U.S. So we're quite excited about that. A super big day, and it will allow us to not only get our technology leadership back, but to be able to combine that with at-scale manufacturing right here in the USA.
Pat, these are really large numbers. Now, you and I have talked in the past, and I think you've been maybe a little hesitant to say Intel's back. But when I see numbers and hear numbers like this and the plants you're building in this country, it sure sounds like Intel's back.
Well, thank you, Sazi. And, obviously, we got to get the technology back. And we had just had our Foundry Day a couple of weeks ago, where this 5 nodes in 4 years, getting back to technology leadership, coming together. We also have to get our product machine executing as well, where we're delivering the best products on that technology. And finally, you have to have the capacity. And this is really the third of those legs. And I just say it is coming together. To say we're finished, I think that's very presumptive. To say that, hey, this engine is coming back to life, there's a lot of evidence that that's the case. And I'm really excited about yesterday's event, just to put a huge exclamation point on that with the president, their commitment, their partnership, and obviously to the entire industry. Hey, we want to be your manufacturer at scale. And, one of the lines I used yesterday, Sazi, is Ohio. That is the AI foundry of the industry. Let's fill it, build it with the greatest AI chips, ours as well as the industry's. This is a powerful moment for the nation.
Pat, this is a powerful moment for Intel. Does it change? When the government says we're going to back Intel in a very big way, does it change your sense of purpose, your sense of responsibility? This is a big rubber stamp of approval.
Well, I view it in both directions in that sense. And when I talk to Secretary Raimondo, she constantly reminds me, Pat, we're counting on you. We are betting on Intel for this. And then I immediately respond and say, Secretary Raimondo, you now have a sales quota for me. Right? We have to work together, right, to bring the customers and to reshore the supply chains of the nation. So it's a huge statement of affirmation, of partnership and investment, but it also is, I think, a moment for the nation to sort of say, we have leading products, we have leading technology, and we're building capacity. Yes, indeed, it is a time to build more resilient, sustainable, and trusted supply chains for the digital future of the nation that is being supercharged by the AI era that we're in. Now it's time to make these moves. And this is a moment that I think really will be defining in that transitioning of the supply chains of the nation, as well as for Intel. We're doing what we said we would. And when we launched this effort, 3 years ago, people said, no way are they pulling it off. Well, the evidence is building. They're pulling it off. No way will we have this level of industrial policy supported by the nation. We're making that happen, and we're building these factories at scale. This is good for the economy, good for the national security. We're excited.
Really stunning stat I came across, Pat, and this is from JP Morgan. They point out that East Asia manufactures 75% of the world's chips. Now, as someone who spent really their whole career in this industry, number one, why has this happened? And then two, how hard is it going to be to get market share back from those East Asia suppliers?
And, when you look at those statistics, it's, frightening. We invented this, and the president made that point very clearly in, his comments yesterday. We invented semiconductors and transistors and everything that we're talking about. But 30 plus years of malaise in the U.S. and industrial policy through the Asian countries has led this industry's manufacturing to move entirely to Asia. And that's a frightening statistic, given how everything is going digital, and we need semiconductors to support that digital revolution. And as we look at the policies that have been put in place, a lot of this is, hey, are we going to measure a 5-year investment on a 90-day shot clock? No way. You have to have policies that are encouraging long-term significant capital investments. That's what the East Asian counterparts did. We need policies that are driving 10, 20, 30-year R&D cycles. That's what our East Asian counterparts have been doing. And by the way, that's what gave us this industry. Coming out of World War II, all of DARPA and the industrial policy investments that were made created the semiconductor revolution. Time for us to get it back. And that's why I say, the capital policies, the long-term tax policies, the R&D incentives that we need for long-term research, and the creation of the talent pools. Taken together, yes, I believe this is a defining point to rebuild this industry for the future. And I'm super happy that I and Intel have been able to play a part in that transformation.
Pat, I'm just going to assume your company is taking market share over the next decade because of these factories you're opening up. But even still, there is going to be a component of chips being made in Asia. As we push into AI, I mean, to use your word, frightening, is it frightening that some of these chips will still be made in another country, given the boom we are seeing in AI and given how fast it's moving?
Yeah, and our objective is not that 100% of these chips move back to the U.S. Our objective is balanced, resilient supply chains. And if we get to my moonshot goal of 50% in US and Europe in a decade, that is such a phenomenal outcome, given that we're almost at 0% of the most leading edge chips today. And at that point, you get to say, oh, we really have rebalanced the supply chain for the world. And to us, I expect that we will need a chips too. In the process as well, Sazi. 30 years of bad policy does not get corrected in one 3-year act like the CHIPS Act. We'll need more sustainable policies to go forward. But I do believe that shift has begun. Our factories and others are starting to be built here in the U.S. Technologies are being researched. We have now engagement with every major AI chip activity in our packaging and foundry. So, this is a great moment, I think, to see those swing back in the right direction. But the world, to me, is one where balanced, resilient supply chains is the answer for the future. And we believe this is a moment that begins that progression.
Some of that's been out pounding the pavement in D.C. and with various lawmakers the past 2.5, 3 years, Pat. What would a CHIPS Act 2 even look like?
To me, it's going to have some characteristics like CHIPS 1, but it needs to focus more on supply chain. We need to bring the rest of the supply chain, the chemical suppliers and systems components, back to the U.S. It also needs to be more long-term research as well. We need to make sure that we're building the seed corn for 2-3 decades into the future. We'll have to have components of workforce. As we enable this, there will need to be sustained capital and tax policies that encourage long-term capital investments that we would have for the future. But the best way that we can make sure CHIPS 2 happen is to make sure CHIPS 1 is highly successful. And I think yesterday was a beginning point for that. But if we're going to go back to Congress and others and say, here's the long-term policies we need to put in place, we need to make this successful. And my hope, Sazi, would be, that at that point, after CHIPS 2, that the sustainability of the ecosystem, that we've rebalanced the costs, that we started to see that ecosystem emerge, because fundamentally this has to be commercially sustainable for the long term. And I'd hope after 10 years or so of explicit industrial policy, we would see that positive spiral emerging that allows us to rebuild this industry that we lost over 3 decades of inaction and a decade or so of explicit and long-term policies. I think we have the chance to get it back.
15, 20 years from now, hopefully you and I are on a beach somewhere, Pat. I mean, it has to happen at some point. We can't keep going at this pace. Pat Gelsinger, always nice to see you. Thanks for making time for us. I know it's been a very busy 48 hours, to say the very least. We'll talk to you soon.
Thank you so much, Lazzy. Bye-bye.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Global population is declining. Birth rates fell by more than 4% last year from 2022, and that could be a problem for the global economy. We want to bring in James Pomeroy. He is HSBC's global economist. James, it's great to see you there. Your note caught our attention a few weeks back when you wrote it here. The note was titled, "The Baby Bust Intensifies." Talk to us just about the economic consequences you see from declining birth rates across the world.
Yeah, it's a fascinating subject, and it's one I think a lot of investors, a lot of economists need to take quite a lot more seriously, because you say it's one of these subjects that's so important, yet it's sort of hidden away from the front pages. And it's absolutely crucial because it's going to determine so many things within the global economy. It's going to impact the size of populations over the course of the next few decades and what that means for aggregate size of GDP, who the world's largest economies are. It's going to matter for growth rates in terms of the share of the population that's working age, in terms of whether we've got enough workers, how we've got enough people to pay for our pensioners, all of these various challenges that are very, very important because of demographics. And when we're seeing birth rates decline as quickly as they are, we start to get quite worried that the world's population could start peaking out more quickly than a lot of people expect. That means lower potential growth in the global economy, particularly in those countries where birth rates are declining particularly quickly.
So James, take the U.S., for example, when we talk about the declining birth rates and what we have seen, many of the millennials not having kids until later in life, and then when they do have kids, not having nearly as many as the prior generation. Talk to me a little bit more about what exactly then that translates into that GDP hit. How big of a hit could we see as a result of this, and what does that timeline look like?
Yeah, it impacts GDP in a number of different ways. But if we think about it through the very basics of the size of the population, if you're having people having 2 or 3% fewer children a year, which is basically the path we're on at the moment in many developed economies, including the US, then further down the line, you're talking about a population that's considerably different in size than your sort of base case you might be thinking about in sort of underlying projections. And that difference between those scenarios can be up to an implication of sort of 0.2, 0.3 percentage points per year in terms of the population growth difference by the time you take this out 10, 15, 20 years. So you're talking about just from the size of the population, potential hits to potential GDP growth that can be up to that range. And then on top of that, there's the additional challenge of the tilt in the shape of the population. So you have fewer young people, more sort of people retiring, and that creates also a challenge for the economy that can mean lower per capita growth as well, because you end up sort of skewing investment in the wrong places and you don't have as many workers and all those other potential challenges we know you can get from sort of misshapen population pyramids. So you're probably talking 0.3, 0.4 percentage points per year in terms of GDP growth difference between a good birth rate scenario and a bad birth rate scenario. And essentially, we're looking like we're going down the bad birth rate scenario at the moment, which means much lower potential growth, not just a 2024 story, but over the next couple of decades.
Hey, James, it's so interesting because some people would look at this and say, hey, maybe it is good news. It's going to take some of that strain, like you pointed out in your note, off of the global when we take into account what we have seen play out just in terms of some questions or some concerns about the environment, and then pairing that too with the public infrastructure. So they're viewing that as almost a good thing. But talk to me, though, more specifically about what it could force governments to do on a taxing basis when we're talking about spending plans, and how that also fits in to that impact you're talking about when it comes to GDP.
But that's it. People like to look at this stuff and they go, isn't this fantastic? We've got this huge climate problem and fewer people means less demand for natural resources. That's clearly quite good news. We talk a lot about housing shortages. That's a key reason, ironically, why people are having fewer children. But you sort of get a shrinking population. You start to sort of take away some of those challenges. So housing shortage, less of a problem. Public transport, less of a problem. Congestion, less of a problem. That sounds fantastic. But it comes at a cost. And it comes at a cost of having fewer workers, fewer consumers, and governments who are still stuck with a very, very large bill to pay because of the debt levels that have been built up in recent years, particularly during the pandemic. And so, to be honest, when you look at the demographic pyramids across the West, they're extremely concerning and something substantial has to be done. But policymakers don't want to make those changes because they're unbelievably unpopular. And you've essentially got a suite of options. And you can start with, you can raise the retirement age. And I'm sorry to everyone watching this, but it's going to have to happen. How high, I don't know. It's going to depend on different countries and when you do it, but it's got to go much, much higher. We're going to have to think seriously about how we're funding things that are used disproportionately by older populations. So that's thinking seriously about pension programs, thinking about healthcare services in economies where there is universal healthcare. We have to seriously question whether that's a sort of plausible model in a situation where a much greater share of the population is older. And on top of that, you've got the other challenge of, do you just raise taxes loads to pay for all of this? Now, no one's going to vote for any of these things. And that's an enormous challenge for many of these economies. When you're talking about 30% of the population being over the age of 65, there's a bill there that's got to be paid. So if you're unwilling to accept those things, you either have to accept being poorer, or we're going to have to think really seriously about migration into a lot of developed economies to try and make up that shortfall of potential workers. But that creates other challenges. Migration is not so straightforward. You have to think about integrating people into the economy, into society, making sure people have got the right skills. And that's another challenge that we're creating. But one of these things, or multiple of these things, is going to have to be done in the coming years. It's just at the moment, none of those things are overly popular.
James, the adoption of AI, is that going to be able to offset some of these concerns? We talk about how AI is going to help with productivity. It's going to help people achieve what they're doing today in a much more timely manner. Is that going to offset some of this concern to some extent?
Oh, definitely. I think it does. I think if you think about not just AI, but broad automation could be a real force for good for the global economy for many reasons, but particularly in a situation where you've got this shrinking working age population and we almost need to create fewer jobs. And actually that risk of AI and automation taking jobs isn't really there because of these demographic changes. But AI doesn't necessarily solve that fiscal problem. And it doesn't solve that challenge of who's going to foot the bill for an aging population. And so we might have to think a little bit more carefully about where that tax revenue comes from, and some of those other challenges are still going to be there. But no, don't get me wrong, AI will act as quite a good counterbalance on that growth front, particularly on the labor market side of things for these rapidly aging populations across the world.
James Pomeroy, great stuff. Thank you so much for breaking down this note. It caught our attention. We were looking forward to speaking with you. So thanks for taking the time, HSBC's global economist. Keep right here on Yahoo Finance. We've got much more of your market action ahead. We'll be right back.
Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th. We're at the first inaugural Bitcoin Investor Day. I've got the founder of Pomp Investments, Anthony Pompliano, here with me. Thanks so much for taking some time this morning. All right, so tell us about the setup for this and why bring the meeting of the minds together like this. You've got Novogratz, you've got Cathie Wood, you've got yourself, of course, leading the conversations. You've got Anthony Scaramucci. What's going on? What do these people all want to talk about right now?
Yeah, so Bitcoin obviously is one of the best performing assets, a $1 trillion asset now, and it's infiltrated now into the traditional financial world. And so most of the conversation has been around Bitcoin, the Bitcoin investors, the holders, kind of the crypto community. But now that Wall Street is interested in this, Wall Street is used to a different type of event, right? They're used to going to earnings days or going out to Omaha for kind of Warren Buffett's entire, lovingly carnival. And so how do you bring people together to talk about an asset or an organization, right? And so they do investor days, and that's what we wanted to recreate here.
Certainly. With that in mind, I mean, we've seen record highs this year. We've seen ETFs come forward at the end of last year. A lot of people wondering, where does Bitcoin go from here? What is next? And what's the next inflection point that you're expecting?
Yeah, so I think that one of the beauty of Bitcoin is that the narrative is so simple, right? For the average person, it's I can just save in an asset that isn't debased. And that tends to protect or increase my purchasing power. Very simple for them to understand. They don't have to be up to date every single day on what is the price or what is happening. The same thing now is kind of that simplicity coming to Wall Street as well. And so Wall Street is saying to themselves, wait a second, we can just buy an asset that protects this quote unquote purchasing power. But when you have individuals and institutions both doing that, that demand outstrips supply. And so from an investor seat, you're like, wait a second, if there's more demand than supply, the price is going to keep going up. Now, is it going to go up in the short term, medium term, long term? How much? When? All these different things come into how much do you want to allocate? How do you put into a portfolio? Are you trading or are you just buying and holding? But really, at the end of the day, it's just okay. If demand outstrips supply, the price is going to go up. And I think that's part of the beauty of this is the Bitcoin community is talking about number go up technology, right? And one of the secrets of Wall Street is Wall Street speculates more than the average retail investor. Right? They have large pools of capital, they wear suits and ties, they got a good smile, but they still speculate just as much. And so I think what we're now just seeing is these investors saying to themselves, hey, we're no different than the average retail person in terms of our psychology, human greed, human fear. And so how do we go ahead and actually express that in the market?
In marine biology, they have what is called a megapod. This is a megapod that's going to be here of whales out there, folks. And of course, whales, some of the biggest holders of Bitcoin. When you think about what their targets are for the end of the year, what is your target for the end of the year? How high do you think we could go for Bitcoin?
Yeah. Nobody knows, right? I think it's the short answer. And one of the reasons why I think people are so excited right now is we violated a lot of the rules that people previously relied on in Bitcoin. So we'd never gone below a previous all-time high. We did that when we went down to 17,000. But we also never hit an all-time high before the Bitcoin halving. And so now we've violated that rule. And so being at an all-time high, going into a halving where the supply is going to get cut in half, I think people are like, oh, this could be different, right?
Does
this
that
could be higher.
A typical event, though, that we should be anticipating?
So I think what it just means is like we're in uncharted territory. Now, of course, people who hold Bitcoin are going to look at that optimistically and say, hey, that means the price is going to go even higher than we thought it was going to go. Another way to look at it, though, is just if we're in uncharted territory, anything could happen. Right? And so, one of the scenarios people don't talk about is maybe we just go sideways for a long time. And that'd be kind of boring, right? And so I don't know what's going to happen, but I do think that, again, the beauty and the simplicity of Bitcoin is that it is the full expression of kind of your economics 101 class. And in finance, I think a lot of people talk about being a free market, kind of investor or theorist, et cetera. But most of the assets on Wall Street are not free market assets, right? There's circuit breakers, there's hours of operations, there's, all these things that happen. Bitcoin seems to be the most free market asset that we have, and so things like supply and demand, just the pure, if there's that more demand and you're going to cut the supply in half, the price should go up much higher.
Yeah. One last question before we let you go. I see that American flag pin that you got on you, and when we think about the year of elections that's taking place internationally, more than half of the world is expected to vote in some fashion or another or take part in elections. What does that mean for crypto? What needs to happen in order for it to be more accepted? come November here in the US and even more so internationally?
So I think some of the most recent kind of surveys show somewhere between 15 to 20% of Americans have played with crypto, hold crypto, invested in crypto, et cetera. So obviously that's a pretty big portion of the constituent base. But on top of that, now you also have politicians that realize, wait, this isn't just like trying to appeal to the voters. I may actually need the technology, right? And so we have seen many countries around the world say, wait a second, should we be evaluating this for central bank reserves? Should we be looking at this for our national pension funds? Should we be looking for our sovereign wealth fund to get exposure? And so it is now becoming a conversation not only on the geopolitical level, not only on the economic level, but then also there's social implications to it. And so in the United States, one of the most interesting things is there's a wealth inequality gap. That wealth inequality gap, if you really look at it, right, it is not about money, payments, spending, kind of all the things people like to point to. It's about education. 50% of Americans have investable assets, 50% don't. The people who don't end up being on the wrong side of that wealth inequality gap. The people who do have investments end up being on the right side of it. And so if we could just teach people to invest or get out of a currency that's being debased, then naturally they will benefit from inflation and the debasement of the currency. And so I think that's what politicians are starting to wake up to, is they're saying, wait a second here, if I can actually help my constituents and I can put them in a better financial position, I'm probably gonna have a good job going for a couple of years here.
Certainly looking forward to a great inaugural Bitcoin Investor Day and looking forward to many more to come after this.
Absolutely. Thanks so much for coming.
Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th.
Shares of Chipotle climbing over 20% so far this year as it gears up for its 50-to-1 stock split in June. Our executive editor, Brian Sazzi, had a chance to speak with the burrito chain CEO, Brian Niccol, about the company's year so far that has been very impressive. And Saz, what did he have to tell you?
Yeah, I can't believe Brian Niccol has been the CEO of Chipotle for 6 years. I still remember covering the day when he was announced as CEO, and going before that, I originally got to know him when he was at Yum Brands, leading that Taco Bell brand and creating a lot of awesome campaigns. But nonetheless, some interesting takeaways from my chat with Brian, and the full piece will be in the morning brief newsletter on Sunday. It's just a taste of things to come in that piece. You can go to our homepage and check that out. But nonetheless, big focus right now by Brian and his team on new restaurant openings. When Brian started, this chain was at about 2,400 locations. They're at 3,400 right now. This year, they will open close to 315 new restaurants. Really a mind-blowing number that not a lot of other competitors are doing. This will be the most restaurants Chipotle will have ever opened in a single year. Now, Brian tells me he thinks he sees a road to 7,000 restaurants over time, mostly in the U.S., but I think increasingly overseas. I asked Brian if he thinks Chipotle can work in China. Potentially. The verdict is out yet, but again, he has a lot of experience in that Chinese market, given all those years he spent at Yum. Also, the company is pushing very aggressively into technology, and they've gotten a lot of attention from Chippy the robot. Now, they've pulled back on Chippy because he told me it's hard to clean. Starting to test a new machine that actually peels and cores avocados. But one of the interesting technologies that caught my attention, Sean, it's this new sensor-type technology, and it's hard to explain, but the bottom line is new sensors that may eventually go into Chipotle to help measure the amount of food going into the bowls and burritos. So something to watch there as well. And last but not least, Brian's still a very young guy. This stock is up almost 600% since his tenure. It outperformed, I believe, actually Apple and Amazon, which is just a mind-blowing number. I don't think Brian is going anywhere anytime soon. I think he's very focused on delivering a lot more restaurants to this group, continuing to improve this culture, and ultimately bringing a lot of people along for the great ride that has been Chipotle.
And he has just been a tremendous leader for the company. You don't have to look any further than that stock performance that you just cited there, just showing the steady increase that we have seen from Chipotle's business under his leadership. He's also been able to navigate extremely tough and challenging times. You talk about the fact that Chipotle was able to perform relatively well throughout the pandemic, post-pandemic. But then just looking ahead, Brian, I'm curious if he had anything to say, or from your conversations that you've had with Chipotle executives in the past, just how they're thinking about the wage hikes that are coming to California, offsetting some of that, and what they're learning in turn from that and applying that to their business going forward. Because we were just talking to an analyst earlier this week who was saying that he actually doesn't really see it as a headwind for Chipotle at all.
Yeah, well, let's keep in mind a good quote first, I think, here from Brian on the number of restaurants he plans to open over time. And again, these restaurants will come at a time of rising wages, and I'm sure a lot of these restaurants, a lot more of them will be in California, which of course is a very large market for Chipotle. I don't think this is just a Chipotle thing. I think the whole restaurant industry is not a fan of wages potentially going up significantly in California, to the point where maybe a lot of restaurant chains and franchisees don't make money. And this is an issue our very own Brooke DePalma has been covering extensively. She'll have more coverage on this throughout the year. But again, this is going to be a problem not just for Chipotle. A lot of, I think, small business owners in the state that operate these restaurants, McDonald's, Burger King, you name it, they're now are faced with significantly higher wages and might have to raise prices. Then you think about what does that do to traffic? Unclear.
Yeah, certainly. Well, the analyst we were talking to earlier this week making the argument that at least Chipotle is better positioned than some of those rivals out there. Avocado, that was the robot's name. I was trying to look it up as you were doing it.
Love
I know, so impressive. All right, Saz, great stuff. Thanks so much. Let's take one more look at the markets here before we let you go. A bit of red on your screen. You can see the major averages just below the flat line. The Dow off 177 points. Stay tuned for the launch of Wealth here on Yahoo Finance. That's all happening on Monday, March 25th. It's our brand new show airing daily between 11 a.m. and 12 p.m. Eastern Time, dedicated to personal finance. It's hosted by my wonderful colleague, Brad Smith. You won't want to miss that. That all starts Monday, 11 a.m. Eastern Time, right here on Yahoo Finance. So that does it for me today, but keep it right here because Rochelle and Akiko have you for the next hour. I'll see you on Monday.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo alongside Akiko Fujita. Here's a look at what we're watching this morning. The Dow on track for its best week of 2024, inching closer to that 40,000 level. All three majors on track for gains as the Fed's outlook provides a tailwind to stocks.
Shares of Apple teetering as investors assess the DOJ's antitrust lawsuit. We're going to break down the long and choppy road ahead for the tech giant as it faces its biggest legal challenge to date.
Indeed, and the Bitcoin sell-off continues. The cryptocurrency hovering around 62,000 there as we see slowing demand for spot Bitcoin ETFs. Yahoo Finance speaks to Bitwise Asset Management co-founder and CEO on the future of spot Ether ETFs. You won't want to miss that.
First, though, let's take a look at markets on this Friday, 90 minutes into the trading day. We are seeing red arrows across the board despite all three majors expected to put some positive gains forward here in the week. The Dow down 181 points, the S&P 500 down 10, and the Nasdaq down 25. Let's take a look at Treasury markets. Yields certainly been in focus this week on the back of that FOMC meeting midweek and this expectation of potentially 3 rate hikes, or rate cuts, I should say, to come. The 10-year yield is at 4.21% and the 30-year yield at 4.39%. Well, we are seeing Reddit shares reversing course today after the social media giant jumped more than 40% in its public debut on the New York Stock Exchange Thursday. You see the stock down nearly 6%, at least in early trade here. Let's bring in our very own Jared Blickery for more on how investors are reacting. Jared, I guess after a pop like that, you do expect a bit of a reversal on day two.
Yes, but all we have to do is look at what Astera Labs did yesterday. And let me explain, because two of the hottest IPOs, two of the best reactions have come this week. You're not seeing it today. Reddit down 5%, but it was up over 50% at the highs yesterday. And let's check out that 2-day price action right here. And if we compute that from the IPO price of $34, you can it's still holding on to gains of more than 40%, though it is off of its highs. And I made a quick comparison to Astera Labs. This is a company that came to list only 3 days ago, so this is also a new listing. It popped over 70% on its first day. So that was the number one reaction this year. Reddit was number 2 reaction, and you can see Astera up about 8.67% right there. And calculated from its IPO price of the low 50s, you can see holding on to gains of more than 33%. Now already Reddit, it's not a pure AI play, but it has attracted the interest of Cathie Wood. And let's take a look at 2 of her funds who just dabbled a little bit in it yesterday. One is the ARK FinTech Innovation Fund. You can see that's down about 1.5% today. And let's check out the 1-year total there. You can see up more than 65%, really accelerating after those October lows late last year. And we're also seeing it added in a small amount to ARKW here. This is the ARK Next Generation Internet ETF, also holding on to some nice gains, up 60% this year. So already a little bit of institutional interest and certainly a lot of retail interest for Reddit. And I'll throw Astera Labs in there too. Great week for IPOs.
Yeah, you never know what's going to happen. I still remember, the year is 1980? Apple went public at $22?
Yes.
So I guess anything's possible, right?
I don't have any recollection, but I'll hold you to that.
Yes, I'm sure I heard it somewhere. I'm sure I wasn't around at that time either. Appreciate you as always, our very own Jared Blickery. Well, speaking of Apple, what is next for the stock? It's still in focus this morning with the Justice Department's landmark antitrust lawsuit filed Thursday, alleging a monopoly in the smartphone market and unfair practices tied to its App Store. Apple is also under investigation for potential violations of the European Union's Digital Markets Act and anti-competitive behavior in its App Store there. Now, Apple has denied these claims. But let's bring in our next guest, Dan Flax, Neuberger Berman Managing Director, to break down where the tech giant goes from here. Good to have you on the show here. So in terms of next steps here for Apple and the stock, given this regulatory overhang, what are the best and worst case scenarios from here?
Good morning. Good to see you. I think from here, the DOJ lawsuit will remain a little bit of an overhang. And of course, demand in the near term, China, general softness in the smartphone market will remain factors. But if we step back and think what's happening here, the iPhone franchise is pretty durable in my view. The install base is continuing to grow. You're seeing a continued mix shift towards higher ASP devices, the Pro and the Pro Max. So I think that is healthy. I think you'll see the company continue to execute well on its product cycles. We'll have iPhone 16, of course, later this year. Services is healthy. You'll see new iPads get launched. And so I expect better growth later this year and into 2025, which can help the stock outperform, in my view, from current levels over the next 12 to 24 months.
Dan, regardless of the result of this investigation, antitrust lawsuit, this is something that's going to take a long time. And the question is, in the meantime, what does it mean for Apple's business as they try to expand, for example, on AI, that partnership with Google and the use of Gemini? How do you think this reframes the way Apple thinks things, knowing that they are now under the watch of antitrust regulators?
Well, the platform companies, including Apple, have been heavily scrutinized, and obviously that is going to continue in the months and years ahead. I think if we look at the smartphone market specifically, the majority of the units sold are Android. If we think about the App Store, actually the majority of the apps there are free, and in fact, Apple has paid out over $320 billion to developers since opening the App Store in 2008. And so we'll have to see how the proceedings and the lawsuit evolve in the coming months. We'll hear the arguments from Apple. From a fundamental standpoint, I think the company has to continue to innovate, to execute on the product cycles. I do expect that to matter more to the share price over the next 12 to 24 months than the DOJ lawsuit. I think the key for the company as we think about services or wearables, Vision Pro that was launched recently, that will take time. They're continuing to innovate, and I think that will matter most when thinking about growth over this short and medium term. And ultimately, it's the growth that, in my view, will contribute to share price outperformance.
Dan, even with that said, though, the question is whether that innovation needs to come from within or sought out through partnerships like a Google. And I mention AI specifically because there's been concern about, whether in fact Apple is a little further behind, at least in their internal development, and whether because of that they need to seek out partnerships. When you know that the DOJ is watching closely about Apple's dominance in the market, does that make it a little more difficult for Apple to keep pace on something like AI?
What I think is interesting is if we look at the iPhone today and the watch, they've been infusing machine learning and artificial intelligence across the product lineup for some years, and I expect them to continue to do that. As we look ahead and think about generative AI, I would expect Apple to incorporate some of its own intellectual property and also to use that of partners. If we look at search as one example, Apple works with all the search providers. Google, which I think is the strongest search provider, has the highest share in the market, and Apple works with them. It works with others as well. I think when we look ahead to generative AI, Apple is likely to work with partners, including Google, and there will be others as well. The key, in my view, it's really this integration of the hardware, the software, and the services to deliver a differentiated user experience that people get delighted with. The key is they're able to grow the install base by harnessing both their own technology from partners, and the developers who build on top of everything. That is really the magic of Apple and their broader ecosystem, in my view. And their ability to nurture that is they have a strong track record, and I think we'll see more of that in the next 2 to 3 years.
And Dan, you mentioned a couple of names there, of course, including Google. When you think about some of the partnerships that Apple has, where else do you see opportunities in the tech space beyond Apple? I know some of the ones you're looking at, Alphabet, Amazon, Cisco, and others. What makes them the standouts for you?
What we look for is the core intellectual property and the ability to translate that into differentiated products and services that users, that customers value, and that drives growth. So if we look at Google, for example, we think they have tremendous intellectual property in terms of models, data, and really the infrastructure to drive growth from generative AI. So we see that as an opportunity. We see YouTube accelerating, and we think the Google Cloud opportunity with enterprise customers remains underappreciated. Amazon, which you mentioned, we continue to like. I think the e-commerce business while sure there are consumer headwinds, they're executing well with more one-day delivery. Amazon Web Services should capitalize on the generative AI opportunity. And we think the advertising opportunity there is underappreciated. And I'll round it out with Motorola Solutions. The ticker is MSI, which is a leader in public safety. CEO Greg Brown and their management team have invested very thoughtfully in building out video and software capabilities. So, for example, many 911 centers in the country aren't able to take in text or video. And so they are helping to modernize the infrastructure for the men and women on the front lines, the first responders, helping to keep communities safe. And so we see significant growth there as well over the next couple of years. So we see and continue to see selective opportunities in the market today.
Dan Flax, always good to get your insights there. Neuberger Berman, Managing Director.
Thank you.
Well, Tesla shares are slumping today. This comes after a Bloomberg report reveals the EV maker is reducing production at its plant in China. That's yet another roadblock amid slowing EV sales and competition in the country. To break it all down, let's bring in our very own Praz Subramanian. Praz, the latest hit for Tesla here. What do we know?
Yeah, so Hugo, this morning we heard Bloomberg reporting that Tesla is going to reduce output at Giga Shanghai through the telling workers to work less, right? So basically, according to sources, workers have been told to work 5 days a week instead of 6.5. I know 5 days is interesting, right? But 6.5 is very interesting. That's not what we were used to here. But the production lines will continue to work 2 shifts a day, which they normally do. That'll remain the same, but fewer workers will be working there. So that means output has been, and they're saying that output has already been trimmed starting in the beginning of this month, and that there could be also longer suspensions in battery workshops, for instance, at Giga Shanghai. So what's going on here is that Tesla shipments in China the first 2 months are actually down 6% compared to last year, and only half of those shipments went to the Chinese domestic market. The rest were exported out. So this happens as meanwhile as overall shipments in China and EV sales are rising. So kind of an opposite situation here for Tesla compared to the rest of the industry there in China.
And we knew that China obviously has its own competitive domestic market when it comes to EVs. How much of that is weighing on Tesla here versus some of the slower growth that we've seen in EV adoption globally?
I mean, today we see the stock down a little bit, and it's no surprise that the business is slowing down in China. We're gonna get Q1 global numbers in another about 8 days. 8-9 days, we'll see what the effect will be. Tesla doesn't break down shipments across the regions, but we can kind of make an assumption as to maybe China's a culprit there for a weakening or slowing sales. So I think it's not. The investment community is aware of this. The stock is down below 170. The question is, I've seen some analysts say this is sort of maybe the nadir, and we're going to see potentially that Gen 2 car. We're going to hear more about software initiatives. You have the Tesla NACS charging here that's expanding, and maybe that might lift the stock higher down the line. But right now, it's more of a demand supply story.
Indeed, and continuing to see those fluctuations in prices for different models there for Tesla as well. I appreciate you breaking that down for us, our very own Praz Subramanian.
Thanks.
All right, well, we're also watching stock of Nike and Lulu falling after their earnings after the bell Thursday. The two sports retailers beat expectations, but also demonstrated a potential shift in the consumer. Now, Nike sales did well in the United States, but fell in every other region, particularly China. Lululemon also warned of slowing growth in North America here. So we're seeing especially Lululemon under significant pressure there, down almost 19% on the day. Well, looking at some of the analyst feedback that we've seen, the team at Jefferies has an underperform rating on Lulu. The title of their note, "Time is up, rent is due, outlook proves brand fading, and 2023 was peak." So they're seeing that even though they had a healthy Q4 that was better than expected, they really did focus on that slowdown in North American sales, and that outlook below consensus for the first time in years. They called that a big deal, so something to keep of note there. And said that some of the things that really drove expectations last year, the growth that they saw in women, they had a big belt bag craze as well that did well. Not seeing them though when it came to Q4. So some concern there. Stifel analysts though maintain a buy rating, seeing this as a good opportunity to buy and really downplaying, well, not downplaying, but perhaps seeing some of these risks as overblown for the North American market.
Yeah, I mean, when you look at Lululemon and Nike, a bit of a different story between the two retailers, although the stock moving in the same direction here. As you pointed out, Lululemon certainly being hurt by consumers pulling back on discretionary spending. You mentioned the outlook being a bit disappointing here. They're talking about a growth of 9 to 10% in the quarter. Analysts expecting around 12.5%. So that coming in a little lower as well. And they're simply just not growing at the rate that they were a year ago, at least in specifically in the Americas region. Nike, an interesting story for me. There's a number of threads here. The thing that stood out to me, Rochelle, you were kind of going through what we have heard from analysts. Barclays giving the steepest cut to Nike stock here, cutting the price target by a fifth. We're talking at $114 a share now. There's concerns about sort of the mix, the product mix for Nike, how that's going to look moving forward, but also the lack of growth or the slower than expected growth they're seeing in direct to consumer, and Nike potentially sort of shifting back to more of the wholesale approach. So that's a big concern for a lot of investors that's watching the stock. By the way, that stock down 14% year to date, roughly 14% year to date. So already a tough road coming into the earnings report.
It's true. I mean, we're seeing some notes about saying that this is a point of transition here. One of our colleagues, Corey, saying, is this the end of sneaker culture? Those are fighting words. You and I didn't seem to think this was the end of sneaker culture as fans ourselves, but we'll be continuing to track those stock moves. Never. All right, well, coming up, we'll head to Bitcoin's inaugural Investor Day for an interview with BlackRock's Robert Mitchnick. That's right after this break.
here with Robbie Mitchnick, who is the head of digital assets over at BlackRock. Thanks so much for taking the time here with us today.
Thanks for having me on.
Absolutely. I mean, first of its kind event that we're seeing here in New York for Bitcoin Investor Day. You got to tell us, for BlackRock, and how you're approaching and looking at and exploring Bitcoin and cryptocurrency more broadly. I mean, how did the conversation really matriculate within the firm?
Yeah, well, this has been a multi-year journey for us, starting back really 2016 kind of time frame. And as this space and this asset class has evolved over multiple years, from an infrastructure perspective, from a regulatory perspective, from a client interest and focus perspective, you've seen our strategy kind of evolve with that to take us to the point where we are today.
And so when you think about education and how you go out to so many of your clients that are out there, what those discussions entail, I mean, what is the education that they already come forward with? And then where do you kind of take it one step further as well?
Yeah. Well, our clients are at kind of all stages of the journey, right? As you can imagine. So with some clients, you know, they're at a very advanced stage. They already hold Bitcoin, sometimes positions in multiple crypto assets, and they're looking for our perspectives on market dynamics and what we're seeing in terms of portfolio construction and other considerations. And others are much earlier in the journey. This is a new topic for them, and they want to understand kind of the fundamentals and the technology and how it works. And so we have those conversations across the spectrum.
What are you hearing from your clients right now with regards to interest in Bitcoin, interest in cryptocurrency more broadly, and whether they want to be crypto touching specifically, or whether they want to go into a more traditional asset like an ETF, perhaps?
Right. Well, what we're seeing is that investors are resoundingly choosing IBIT for Bitcoin access, right? That's a combination of investors who are new to Bitcoin and those who maybe held exposure in a different form historically. What our clients, I think, are most focused on is trying to understand risks, upside, downside, thoughts around portfolio construction, how to think about the risk in a larger, diversified portfolio context. So those are the kinds of discussions we're having a lot.
Just lastly, while we have you here, a lot of people wondering what's the next big inflection point for Bitcoin, for cryptocurrency more broadly. What is that from your perspective? What should we be watching for?
Yeah, well, I don't think there's maybe one specific thing that we're looking at. I think it's a combination of, over time, as more clients, more investor types across various archetypes, some of the big institutions, their education and research journey, some of our wealth advisory partners, they're on their own sort of diligence and education journey, and those will slowly play out. In the early days, it's been a lot of sort of end investor direct and ultra high net worth, and that's going to evolve as more investors get comfortable with the asset.
Robbie, thanks so much for taking the time here today, and bustling and busy Bitcoin Investor Day here. We know you got a packed schedule. Can't wait to hear from you on stage.
Yeah, thanks for having me.
Absolutely. Thanks for taking the time.
Stocks mixed this morning after all three major averages hit fresh record highs this week. This comes after the Fed reiterated its 3 rate cut forecast this year. But what can keep this market momentum going? To break down what sectors traders might want to keep an eye on, Angelo Korkafas, Edward Jones Senior Investment Strategist, is here. Thank you so much for joining us this morning. So it seems that, the market's digesting a bit of everything that they heard this week, both from the Fed and some of this news that's also weighing on some of these tech stocks as well. How should investors be looking at this period of time now that the Fed has reiterated that it is going to be 3 rate cuts? We just don't know when.
Yes, thank you for having me. This week, we did get a lot of progress with the expectations for rate cuts being really cemented, but not only the Fed, but other central banks as well. So the bias is going to be to ease. Of course, central banks are going to be data dependent, but it was encouraging to see that the threshold, the bar for further rate hikes or even a prolonged pause is pretty high at this point. No doubt markets have seen an exceptional rally over the last 3-4 months. So we might be due for a breather, or I would say a period of consolidation. However, as long as the economy stays out of recession, which we think it will, inflation continues to moderate, and the Fed, along with other central banks, start letting off the brakes a little bit, I think that can be an environment that remains supportive of equities.
Has this shifted your investment case in any way, Angelo? I mean, based off of what we heard from the Fed chair on Wednesday?
Not really. I think earlier this year, the market expectations were very aggressive for rate cuts, but now we've seen that convergence. We have always, since the last 3-4 months, being of the opinion that the Fed would not cut more than 4 or 5 times that the market were expecting. But now we have this convergence, and that brings a little reassurance that at least on that front, that interest rate adjustment or recalibration has already taken place. However, we have seen, and we are seeing a little bit of complacency, which might result in a little bit more volatility in the months ahead. But any pullback will likely prove to be short-term dips as long as the economic backdrop remains positive. So not change from what we heard this week, more so confirmation of the uptrend in stocks and expectations for rate cuts.
So, Angela, with the upswing that we saw in the rally driven by these valuations here, how well supported are they, and how much broader does the rally need to be to really have legs?
Yes, one other encouraging factor has been that we are seeing more recently, the past month, a broadening of market leadership, which is encouraging as investors gain more confidence about the economic cycle. So far, the gains, as you mentioned, have been largely driven by gains in valuations. So looking ahead, what might drive further gains, it's going to likely have to be further improvement in corporate profits. And the encouraging fact is that the last earnings season, we're about 4 weeks before the next one, but Q4 earnings proved to be much better than expected. So that reacceleration in earnings appears to be intact for now. But really, the heavy lifting is going to have to be done by earnings.
Angelo, with that said, give me your top 2 sectors right now.
Yes, we like industrials, which is a sector that can benefit from that broadening in market leadership. And also consumer discretionary is a sector that has both growth and also cyclical characteristics. We have Amazon and Tesla residing there, but also the retailers, and we see the consumer resilience remaining in place, supporting by a strong labor market. So these are the top 2.
Angelo Korkafas, Edward Jones, a senior investment strategist. Good to talk to you today. Appreciate the time.
Thank you.
Well, the Biden administration will begin phasing in new tailpipe emissions rules for passenger cars and trucks. The rule passed on Wednesday is another push by the administration to accelerate the transition to EVs and hybrids. even as drivers express some concerns about the lack of EV infrastructure. Our next guest is looking to build out that infrastructure, and we've got Terry O'Day. He's In Charge Energy CEO. Terry, it's good to talk to you today. How big of a bump do you expect to get for your business as this transition to EVs accelerates?
Well, our business is already growing year over year. We're over 250% growth for the last 4 years. So this new regulation is really an opportunity to align the industry against some targets and provide some investor certainty as we seek to build out the infrastructure. We'll have some certainty to know that the vehicles will be there on the road.
And Terry, in terms of maintaining some of that infrastructure, obviously people are still waiting to get, a supercharger that's close to them because, some of these level 2 chargers still taking a considerable amount of time. How should people be viewing that when it comes to the speed of repair and maintenance that also needs to come with this infrastructure change?
Sure. Well, already for most people, the answer to the question, where is the closest charger, for me, is in your garage, right? So as we build out the on-road charging solutions and we build out more fleet depots and we reach more people in parking lots where they might be working, or if they're in apartments where they might park overnight, that infrastructure continues to grow. And it's really remarkable how far it's come along already. But for our company at In Charge Energy, we design, engineer, install, and maintain the charging station. So we have a team of service technicians in every state and province in North America that goes out and services these chargers so that you can rely on them being operational when you show up to charge your vehicle.
On the issue of multifamily units, I keep bringing this up as somebody who drives an EV and has an apartment. It is really hard to find a place that has that kind of infrastructure in place for those who live within the apartment. And I live in California. Why has that deployment been so slow? And what needs to happen to accelerate that?
Well, that is a tough one because you have both the tenant and the landlord that you have to work with to get a solution for a multifamily residency, right? So what you probably will mostly rely on until that infrastructure evolves, you'll rely on the on-road charging stations like the superchargers you mentioned, or like the existing gasoline fueling model that we have relied on for all of these years. And these chargers are getting faster and faster, and the reliability is getting better, and they're becoming more ubiquitous in, throughout our cities and in connecting our cities. So you can find these chargers and you can use the vehicles just as you have with your gasoline powered vehicle, but get even better performance and lower maintenance costs.
And Terry, I have to ask, for some of these partners that you work with, what are the key selling points when someone is deciding, should I move my fleet to EVs, that I want this, a dependable source of being able to charge, but then some of the costs for some of these installations as well. How do they really balance those costs?
For sure. Well, we are focused on fleets in particular. So some of our customers include UPS, FedEx, PepsiCo, Anheuser-Busch, and these companies are coming to electrification and choosing electric vehicles because it saves them money in operating their fleets. And when they save money operating their fleets, they get to pass those savings along to consumers. What these fleets are doing is they're making these investments now, anticipating these savings over time. And the real leaders are continuing to make these investments in their infrastructure so that they can remain competitive as this new technology evolves.
Terry, what does that investment look like? To what extent have you seen an increase in that capital spend, specifically around charging stations, if you're talking about some of the biggest companies that are deploying their fleet?
Yeah. Well, in the fleet market, you're seeing multi-million-dollar commitments from some of these major brands. And the leaders have made these commitments because they can see that already the cost of operating an electric vehicle is lower than the cost of diesel or gasoline. And just as importantly, the cost of the fuel is more consistent than gasoline or diesel, which fluctuates a lot. So the consistency provides your fleet managers the opportunity to forecast their costs and to save their customers money. So each of these companies has made multi-million-dollar investments. And we also serve school districts, for example, that are very focused on saving money and getting money back into the classroom and keeping our kids healthy. So we have some of the largest school bus deployments with electric fuels in the country. And we provide those charging stations for them to keep those vehicles on the road and safe.
So Terry, what does the product roadmap look like from here? As you know, the Biden administration investing more in this space, but then you look at what some of the global competition is doing, not just with installing some of these chargers, but also things like battery swapping technology.
Battery swapping is a really interesting technology and opportunity, as we know that, when we talk about real estate, there's three things to think about: location, 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 right? With electric vehicles, there's also three things, right? It's batteries, batteries, batteries. And so battery swapping is a way to kind of reduce the cost of operating your vehicle by allowing you to offload the battery and charge it offsite and then switch into a new battery. But really the technology for batteries is that it's getting less expensive because we're manufacturing them on a larger scale. And as these battery costs have come down, that's where the long-term lifetime costs of operating your electric vehicle are now beating diesel. And so that's why fleet managers are beginning to find electric technologies as a solution to reduce their costs, provide them more certainty, and give them lower maintenance requirements.
Well, we appreciate you taking the time to join us this morning. Terry O'Day, In Charge Energy CEO. Thank you so much and have a great weekend.
Thank you very much.
All right, we're watching oil prices remaining steady today as WTI holds above that $80 per barrel level. Futures have been around this range this week. Inez Ferrer is here with more on the movements that we've been seeing. Hey, Inez.
Hey, Rochelle. Yeah, and we are seeing today oil futures with WTI, as you just mentioned, right now just under $81 a barrel. Little bit of pressure on oil prices right now, down about 0.3%. Not much, though. I mean, still holding up above that psychological $80 a barrel level. Now, you do have the U.S. dollar index, which is higher today. And since oil is invoiced in dollars, if the dollar goes up, that means that prices generally go down a bit because you need less dollars to purchase that oil. You have Brent crude that's trading just above $85 a barrel, also 0.2% off. There has been also some optimism over over talks of a ceasefire between Israel and Hamas. So perhaps that is putting a little bit of pressure on oil prices. But nonetheless, make no mistake here, we have seen a run up in prices over the last couple of weeks. I am going to pull up a 12-day chart here. You can see up more than 4%. You are seeing falling inventories. We have also been seeing those continuing OPEC plus output cuts. And then Russia's crude refining has dropped to a 10-month low because of those Ukrainian drone attacks on Russian refineries. When the customers for those Russian refineries can't get their products from there, they have to go elsewhere in the world to get their products. So look, this is all having an impact on oil prices. We are seeing year to date, WTI is up 14%. Brent crude up 12% year to date. Analysts are saying that the run up that we have seen recently is a little too fast. So you may see a bit of a pullback, but nonetheless, we are seeing oil prices higher for the year. And this is also, by the way, impacting gasoline prices as well.
As always, Inez Ferrer keeping a close watch on the energy space for us today. Well, coming up, our very own Brad Smith is live from the inaugural Bitcoin Investor Day. He's going to talk to Bitwise CEO, founder, and CEO, Bitwise co-founder, I should say, and CEO on the other side of the break. We'll be right back.
Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th. Welcome back to Yahoo Finance. We are live from the Bitcoin Investor Day, the inaugural Bitcoin Investor Day, I might add. And we're joined now here by Hunter Horsley, who is the Bitwise Asset Management CEO and co-founder. Great to have you here with us.
It's great to be with you, yeah.
Absolutely. I mean, we've got a vibing event taking place here today. Bitwise is represented. We know that Scaramucci, we know that Novogratz and Galaxy have all been here. Why do you think this meeting of the minds is so critical at this juncture for crypto?
Yeah, I think that, so Bitwise, we've been around for over 6 years now, serving investors across the country. I think that a lot of investors are very familiar with crypto, with Bitcoin, but the launch of Bitcoin ETFs was a turning point for the space. And I think that now is sort of the time that a lot of traditional investors finally feel that they can engage, and events like this are helping make that happen.
When we think about the ETF activity that we've seen as of recent, of course, milestone marker for the entire industry. We've seen a little bit of outflows recently for your own firm. How do you think about that kind of day in, day out, inflows, outflows, and ultimately what the selling point is for a lot of new people who are still trying to figure out whether or not it's right for their portfolio?
Yeah, it has been stunning, to be honest, to watch these Bitcoin ETFs come to market. The Bitwise Bitcoin ETF in 2 months has grown to over $2 billion in assets. It was in the 25 fastest ETFs to $1 billion in the 30-year history of ETFs. And what that represents is a whole new class of investors who feel they've heard about Bitcoin for a long time, but finally, in 2024, they can participate, they can access it. I almost sometimes think of it as being a bit like Bitcoin's IPO. Maybe you've heard of AI, you've heard of OpenAI, but for most people, even though you're hearing about it, you can't necessarily invest in what's happening there until OpenAI goes public one day. And for many investors, Bitcoin has been like that. Particularly a lot of our clients that are wealth management firms or institutional investors, they've been interested, but now with the Bitcoin ETF, like the Bitwise Bitcoin ETF, they can get access, and so we've seen a huge amount of uptake in the 9 or 10 weeks since they launched.
When we look at the equity markets, and we typically are tracking perhaps a multi-day or multi-session sell-off, the investor sentiment, it can grow a little bit weary. It can be asking questions of, okay, what is the correct trade? Do I also need to get out of a position? When we see a multi-day type of slippage in crypto, what is the thinking that you're hearing from some that are out there right now?
Yeah, that's a great question. Right now, amongst our client base, I would say that people are pretty optimistic about the outlook for Bitcoin. We haven't seen clients really change their mind or change their positioning. Bitcoin is, of course, if you zoom out, up over 40% year to date, which is sort of doing what people would hope for the asset class. Had an amazing year last year. And a lot of our clients take a long-term outlook. They invest because they have a view on what might happen over the course of a year or multiple years. I think a reason that a lot of clients work with Bitwise as a specialist in the space is because the space moves so fast. And when you have a week where the market is having volatility or something's happening that you don't understand, they love being able to have a partner in the space that can take them through what's going on. But I don't think that there's a really important development behind the price action this week. I think it's pretty typical Bitcoin volatility, and for some investors that creates opportunity. But I don't think that there's a real change to the fundamental opportunity of Bitcoin.
You've already got the Bitwise Bitcoin ETF out in the market. When Ethereum do you think next?
Yeah, so at Bitwise, we've been around for over 6 years. We have over 15 investment solutions. We launched a crypto equity, an ETF that holds crypto equities. It was the first ETF that the SEC allowed to have crypto in the name. We have the largest publicly traded crypto index fund. And I say that to indicate that we view our role as a specialist in the space as working to bring opportunities to investors when that becomes possible and when an opportunity matures. So we're working on an Ethereum ETF as well.
How soon could we see that?
So the SEC has a deadline to make a decision of May 23rd, which is not too far off. I think right now, if you ask most issuers, you would say it's 50-50 what will happen. But our approach always has been to be a constructive partner to the SEC in evaluating the risks and considerations. And so if it doesn't happen in May, we'll continue working on it.
Just lastly, while we have you here as well, this is an atypical setup that we have going into a Bitcoin halving, where you've got all-time highs that Bitcoin and the crypto market cap is trying to get back to, but Bitcoin has already struck. What is that set up for this halving to be different, perhaps, in the price action that we might see?
Yeah, so historically, halvings are sort of become a focal point in advance because of the way that they reduce the amount of new supply, and that impacts price because of the supply-demand dynamic. Looking at prior halvings, there is usually a bull market, an extended bull market after the halving, regardless of what happens before. You know, beforehand, investors are trying to price in or speculate about the impact of the halving, but after it happens, it's like initiating a buyback program for a stock. You know, investors can take views on that in advance, but once the program begins, the company's out there buying back its own stock every day, and that has an impact on the market. And similarly with the halving, it will definitely have an impact. And I think it'll be very constructive to Bitcoin for Bitcoin investors.
Hunter Horsley, who is the Bitwise Asset Management co-founder and CEO, thanks so much for taking the time.
Absolutely, my pleasure.
Absolutely. We'll have much more here on Yahoo Finance. Stick around. We'll be right back.
Both Medicare and Medicaid will now provide coverage for the popular weight loss drug Wegovy, but only for those who may need to take the drug for heart disease-related conditions. Let's bring in Yahoo Finance's Anjali Kamlani to give us those details. An interesting development here, Anjali.
That's right, Rochelle, and one that, of course, investors were waiting for because they knew that Novo Nordisk had done this study for heart disease. When they got the approval from the FDA, it then really opened the door for CMS to cover this. So now Medicare Part D will cover the drug for those who get it prescribed for heart conditions. If you recall, the FDA did expand the label for Wegovy, which is Novo Nordisk's weight loss drug, because it showed a 20% reduction in heart disease. So with that came, of course, the door opening for coverage. Medicaid also at the state level will now be required to cover this. And this came from guidance from CMS, who sent Yahoo Finance a statement saying that Part D coverage is still not available for weight management. So it still isn't available for those who want to use it for the original purpose. However, they can now use it for this reason. Now, how does this affect those, $100 billion market estimates by the end of the decade? Well, Mizuho analysts are saying that it actually just reinforces the stance. So Jared Hull said in a quote, "We do not believe the street will greatly alter near-term estimates, if at all, but the chasm between supply and demand remains incredibly pronounced." And so what we're dealing with now is increased uses for the drug, but still the issue of supply. We know that not only Wegovy, but also Eli Lilly's Zepbound are in high demand after their approvals, and that only seems to continue with the other studies that are now down the pike. Eli Lilly does have a heart study in the wings. It's slated to end sometime this summer, so we're going to get a readout then. It's likely to follow suit, so bodes well for Lilly as well. Meanwhile, the two companies are also studying things like liver and kidney disease, sleep apnea, as well as potentially addiction. There have been some advocates for that. So it really just, the story really is just going to continue from here.
Indeed, and that demand certainly not going anywhere. Appreciate you breaking that down for us, our very own Anjali Kamlani. All right, well, don't forget to stay tuned for the launch of Wealth here on Yahoo Finance starting on Monday, March 25th. It's our brand new show airing daily between 11 a.m. and 12 p.m. Eastern Time, dedicated to personal finance and hosted by our wonderful colleague, Brad Smith. You won't want to miss it. That does it for now. I'm Rochelle Akufo alongside Akiko Fujita. Thanks for watching Yahoo Finance.